Hello, everyone. Good to be with you this morning. For those of you in attendance, it's because you have a managed account with us at Security First Asset Management and our Pershing accounts. This is a review of our year-to-date and quarter up through the end of September of 2021, your portfolios. We're going to be talking a little bit about how we used to manage the accounts, what kind of changes we've made, the philosophy behind it, and some performance details. So we also are recording this event, so we'll be able to email it out to anyone else that has Pershing managed accounts. Shayna's with us here as well, and she's going to be fielding any questions. Feel free in the chat box over to your right. I believe it's your right. Feel free to type any questions you have, and we'll make sure to answer those. But we just want to start doing this each quarter where we're doing a review of the portfolio, what changes we've made, at least an idea of some of the changes we've made, and a little bit of the philosophy again behind why we do what we do. So with that being said, we're going to go ahead and get started. And let's take a look here. All right. So again, this is a review of our managed accounts at Pershing through the end of September. So let's take a look at a couple of things. Let's talk a bit about our investment selection approach. So as you know, a big part of what we do is identify blue chip stocks that have a long track record of delivering value. And we also have a portion of the portfolio that we use in strategic ETFs. That portion we may move in and out of the market depending on what markets and the economy are doing. So we use that sleeve of your portfolio. The ETFs that you see in your portfolio in general are for risk reduction, risk protection. We're trying to manage downside risk. The blue chip stocks we only trade out of if they reach our overvalued category. So that when we make the investment selection, it's a buy, and then it'll become a hold eventually as the price rises. And then at some point, if the price gets too high compared to the historic dividend yield, it will become a sell. And at that point, we would typically trade you out of your blue chip stock into another blue chip stock. That's generally the approach we take. So let me give you a little bit of background on how we select the stocks in our portfolio. Number one, we want them to be undervalued. You never want to buy things when they're overpriced. And there's sectors of the market right now that are very overpriced, especially in the tech sector, which we're going to get to in a moment. For our blue chip stocks, we want them to have an S&P quality rating of A- or better. We want them to have a long-term dividend history. We want to see that they have dividend growth 7 out of the last 12 years, earnings increases 7 out of the last 12 years, a PE ratio, if we can, of 15 or less, and a payout ratio on that dividend of 50% or less. That means that the cash flow that they have from operations, we want less than 50% of that going towards paying the dividend. That means that they have the ability to continue to pay that dividend and raise the dividend. Utilities, we want to see a lower 75% or less payout ratio for utilities. They have a little bit higher ratio because they operate differently, but they're also very stable generally because they're paying out their cash flow. We want to see 5 of these 6 criteria met for them to be entered into our pool of selected investments when we make the choices for which ones to include in your portfolio. All right, so we just touched on some of this, but the key here is we're using blue chip stocks, and we use one of the firms we use to get research from is Investment Quality Trends. They do a great job and have a 30-plus year track record of identifying some of the stocks that we consider. We don't use, there's a lot of different options. We eliminate certain sectors of the market, and I'll touch on that in just a moment. But again, these are the criteria that they have. A few others that we have in addition to what I mentioned before. We want to see a lot of volume. We want to see 5 million shares outstanding of stock. These have to be larger companies, at least 80 institutional investors, and 25 years or more of uninterrupted dividends. When these hit the criteria, generally they're going to be more stable. these are solid companies. These are not new companies. That provides us with stability and, we believe, lower downside risk. Another thing we factor in when we're choosing the investments to add in the portfolio are what sector of what time period are we at in the market cycle. We believe that we are really entering into a recovery phase, but we are heavy in consumer staples and utilities, not so much healthcare at the moment. But we are very underweight compared to the S&P benchmark, very underweight technology stock and energy. Those are sectors that we feel are very volatile. So we typically don't have much exposure to them in the portfolio. This is an X-ray, a Morningstar X-ray. What that is this shows a breakdown. This is for a moderate risk portfolio, the current breakdown of how it's invested. All of you are welcome to get access to this. In fact, what I'll do is in the email we have when we send these out, I'll put this X-ray in there for you to see. So if you're in a moderate risk portfolio, this will align with yours, and I'll also put a growth X-ray in as well. So this just kind of shows you in detail how your portfolios are broken down. If you see in the middle section here, there's a triangle, and we are tilted towards consumer defensive stocks as far as diversification goes. It's exposure to technology. We only have 11% of the portfolio with any exposure to technology compared to the benchmark of 24.63%. But the big overweight sector is defensive stocks. Consumer defensive stocks make up 20% of the portfolio. Utilities make up 13%. And then at cyclical stocks on the top, we have 12.5% in cyclical, consumer cyclical stocks, and only 8.5% exposure to financial services compared to the benchmark of 14. So what we're trying to do is to give a good risk-adjusted return. And at the bottom right, if you look at where it says equity style, our PE ratio average for the portfolio is 16.7% compared to the benchmark of 24%. So we have lower risk. PE ratios, one of the risk metrics is how much are you paying for every share of stock that you own for every dollar of earnings that they have. We're paying 16.7 times earnings in the market. The S&P is paying 24.09%. So less overall risk as far as overpaying for stocks goes. And this is a continuation of that, and it shows we fit into large cap value style. That's where we're at. Most of the portfolio is made up of large cap value stocks, and we think value is the more conservative place to be. We don't have a lot of exposure to the growth stocks because they're objectively overpriced at this time. A couple of changes we've made in the portfolio in the last quarter. QYM was one of the names that we held in the portfolio. We did sell that stock during the quarter, and we realized a return on that. And you can see that the valuations are low on it. It still has good growth potential, but it's overvalued. So we got out of Chewy.com. Another one is the ODP Corp. This is for Office Max and Office Depot. Their earnings record came out. Their earnings report came out, and they had negative earnings. So it didn't look like a good position to hold on to. So that's another one we exited during the quarter. So let's take a look ahead here. Financial indicators, even though we've had volatility through the month of September, we saw significant volatility. We saw our first 5% decline since October of 2020 that happened in September. And, you know, when we hadn't experienced volatility for a while, it makes people a little nervous. But this is some research that shows that there's still a lot of room for growth. We think growth rates will be slower than what we've seen this year. First quarter of this year, the average S&P company beat by 30%. We don't think we're going to have those types of growth numbers moving forward. But on almost all fronts, we see positive economic indicators over the next 6 to 9 months. There are a few headwinds. Overall, equity market valuations are slightly elevated, especially in the tech sector. Those are much more overpriced. We have issues with the political environment, possible tax changes coming that could be negative to the market. But overall, these indicators all look pretty good. Even consumer sentiment remains strong. Monetary policy is accommodative. So the outlook's pretty strong for the next 6 to 9 months. We don't see any indications of recession in the short term, but I am going to touch on some other concerns that we're watching very closely. Before I move on, I was going to mention year-to-date returns. So if you own an IRA account that we manage at Pershing, your net of fees are up right about 9%. Now, there is the possibility you have other investments inside of that account, like alternative investments or real estate funds, but we're talking about the core holdings that we've managed as far as the blue chip stock portfolios. They're up, moderate portfolios up through the end of September, about 9%. We've seen more growth and recovery really from September in the last few weeks. Today, the market's up again. Some good news coming out on the employment front today. The growth portfolios are up 11.1% net of fees as well. So that's where we're at as far as returns goes through the end of September. Again, you're probably up a couple percentage points since then during the month of October. So let's talk about one thing we're watching closely, and that is inflation. I'm sure you felt it in your pocketbooks. The costs of all kind of goods, services, products have skyrocketed. We've had the steepest increase in the consumer price index since January of 1991. And this is running through the end of August 2021. Overall inflation rate is up 5.3%. That's the inflation rate we're seeing through the end of August. 5.3%. That's for all goods. Now, energy sector, 25% inflation rate on energy. And there's a lot of issues with that. I posted this morning on my LinkedIn page about some of the issues with coal in China. China's trying to get away from coal, and that move is increasing energy prices globally. Also, the oil and gas sector, as you know, there's been a high demand for gasoline since the pandemic has slowed down, and so there's been some supply constraints as well with oil and gas. So energy is much higher than the rest. If you take out food and energy, the CPI is at 4%, 4% inflation, and that's the highest we've seen since January of 1991. Many economists feel this is going to be transitory, meaning that as soon as the supply chain issues are worked out, that consumer prices will resume to being normal. I am somewhat skeptical of that outlook. I believe the Federal Reserve and some of their policies are creating some of the inflation we see. Also, the stimulus checks that have been sent out to families. When people have more money, they typically spend it more. And when you have more of something, it's worth less. So there's a lot of excess savings and capital floating around out now in the economy. That drives prices up. So I'm hoping that in the first or second quarter of next year, this slows down, but we're keeping a close eye on inflation. So let's talk briefly about some other economic headwinds that we see that could potentially be an issue. Public policy risks around taxes and corporate tax rates. That's something for 2022 we're watching. A lot of folks are still choosing to not be employed. The unemployment rate is dropping. It's down in the 4.5% range, but part of that's people that choose not to work aren't included in the unemployment number. There was over 4 million people that quit their jobs in the month of August. And some of the reasons that we think that's happening are they know there's a lot of job openings and they're choosing now to go to a job they feel more suited for. But unemployment rates are something that we're watching. And you obviously have to have workers to have products and services. One bright spot in that is we've seen a lot of jobs being filled in the hospitality sector, in restaurants and in hotels. So there's things we're watching. So obviously the recovery can still be derailed, but right now it doesn't look like that's happening. We try to look at the data. If you watch the news headlines on CNN or Fox or MSNBC, they're selling ratings. They're trying to get viewers. So what we do is we look at the economic data. That's unemotional, right? The news cycle is very emotional. It makes us feel like things are terrible. At least it does me when I watch it from time to time. But we look at the numbers and projections and see what's actually happening, because we're not selling headlines, right? And we're trying to avoid the emotional side of it. So the data we see is actually pretty positive. We don't think we're up for a recession or anything like that in the short term. So these headwinds are something we're watching, but right now we're on track to have a good 2022 and hopefully a strong end of 2021. I wanted to mention the difference between growth and value. So growth stocks are companies that are focused mainly on growth. So your companies like Amazon would be considered a growth stock. They typically pay out little to no dividends, and most of their earnings are kept in the company. And the PE ratios, people are paying 40 and 50 times earnings, and for Tesla, upwards of 200 times earnings to own that stock. And the hopes are that their earnings eventually catch up to the price. But for us, that's too speculative. We like companies that have proving earnings record and a dividend track record. But what that means is we may lag the overall S&P to get that stability. The orange line you see here is growth stocks. So growth stocks have been very bullish all the way back to 2014. Value stocks have underperformed growth. But if you look after the dot-com recovery, when we have some serious market shocks, value stocks are favored over growth during those periods of time and typically outperform. And we think that there is a rotation back to value. Some of the tech stocks that are out there are at dot-com level pricing. And if you had any experience back in the late 90s, early 2000s, and you owned any technology companies, we saw serious declines in those prices, much more than any stable value stocks. So our clients in general want to have a smoother ride than just looking at the growth. So one thing I was going to mention for last year, the big growth names that everybody hears about, Google, Apple, Facebook, Amazon, Microsoft, if you were to take out the 5 top tech companies out of the S&P 500, so Facebook, Apple, Amazon, Netflix, Google, you take those 5 out, the S&P would have returned 4% last year instead of 18, just taking those 5 stocks out of the index. That tells you how overpriced they are and how much influence they have on the S&P 500 index. So we don't own these names. We do own some Apple and some accounts. And, for our IRA accounts, they're going to follow the model very closely of owning value stocks. If you own non-qualified Pershing accounts, we have to tailor our investment approach a little more closely because of the tax implications of buying and selling different names that you may have already owned before you came here, or things that have a lot of growth. We can't just sell things easily in a non-IRA account because you'll have to pay short and long-term capital gains if we were to do so. So the returns that I've been talking about today in our portfolios are for the IRA accounts, not the non-qualified accounts. All right, so that leads us to this question. We've had a strong recovery from the bottom of the pandemic through today. Markets are still looking very favorable, but how much longer do we have to run, right? If we look at different expansionary periods, after the recession in July of 2009, we had 10.7 years before a recession. The average length of time during an expansion, which we're in now, is 5.3 years. And we're about a year and a half into an expansion now that started, a year and 3 months, that started in the summer of 2020. So there's no reason to believe we're going to have a massive market decline and correction. The data is not showing that. And if we look back at history, and Mark Twain said history doesn't always repeat, but it rhymes, right? We don't think that we're in for a major market crash, but we always have downside protection in the portfolios, and most of our clients have investments that have some principal protection from the market as well. These accounts should be viewed as your long-term growth money. This is your best hedge against inflation, which is real and which is happening. So when you need exposure to equities because they are the best hedge against inflation. Another thing I was going to mention is intra-year declines. The number of times markets drop more than 10% a year is pretty frequent. Going all the way back to 1980, it's happened many times, but 80% of the time when we have a 10% market decline, the market recovers during the same calendar year. So volatility shouldn't be a huge concern that we're experiencing. The main thing is, what are corporate profits doing? And right now they're solid. And the forecasts remain solid for corporate profits. And that's what drive market returns. But if you have exposure in other accounts, not in ours, to large tech companies, or if you own S&P 500 funds, or you own the C-Share and TSP, most of the things driving your returns are those 5 tech companies that I mentioned. We believe you need to be more targeted, and that's why we look to value stocks that hit the criteria that we mentioned. So I hope this has been informative. Let's see if we've had any questions come in. I don't think we have, but this has been recorded, and we will provide this presentation to you so you can have access to it and review it whenever you'd like. And I will also include a Morningstar report. But I hope this has given you a little bit of an idea about how things are going. We've seen very solid returns this year, and we think moving forward we'll see slower growth, but still we should see growth moving forward. We are watching the supply chain very closely as we move into the holiday season to see how that may impact corporate profits. So I hope everyone has a great day, and I hope to see you soon in person. If you have any questions at all about your accounts, please reach out to us. We're here to help and serve you. Have a great day and take care.